here we are, silver at $41 an ounce, and you won't see a word about it on the evening news tonight. Or gold at $3,539. Don't tell. 42 million ounces of silver delivered, which is huge. We talked about the shorts are up big time in SLV, which is huge. We talked about the BRICS meeting, the Shanghai Cooperation meeting. I think what I take away from that is that Trump overplayed his card with India, threatening 50% tariffs. When you look at the actual numbers, even though we are their largest trading partner, arguably, it only accounts for under 3% of their GDP.
Silver price news targets $41, $47, and $66 as Fed liquidity sparks bullish momentum. The precious metals market is buzzing with excitement as silver emerges from a prolonged consolidation phase. After months of sideways trading, technical indicators are aligning with macroeconomic tailwinds to create what many analysts are calling a perfect storm for silver bulls. With the Federal Reserve potentially shifting gears and inflation concerns mounting, investors are eyeing silver as both a hedge and a growth opportunity. First target, $41. This breaks silver out of its current range and confirms the bulls are in control. It's not just a number, it's a statement that the consolidation phase is officially over. Second target, $47.6. Here's where things get exciting. This Fibonacci extension level represents serious momentum territory. A push to these levels would grab headlines and pull in momentum traders. Third target, $66. Now we're talking about a completely different silver market. This long-term projection would represent a fundamental repricing of the metal, putting it in rarefied air not seen in over a decade. Dream scenario for metals investors. Everything's lining up for what precious metals enthusiasts have been waiting for. Fed policy pivot, check sticky inflation, check economic uncertainty, check it's like a checklist for precious metals outperformance. Now smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
You know, in early, mid-2025, I think most people would have been happy about that. Quite frankly, I think it's just beginning. We're a long ways away from seeing where this ultimately stops, but this is where it should have been a long time ago, and I think it's still got a lot of room to run based upon everything that I'm seeing, whether it be anecdotally or economically, or just by the movements of the biggest players in the world with Russia and India and Saudi Arabia and China. They're all gobbling up silver as fast as they can. Evidently, so are the folks in the United States now, too, at least on the COMEX. When that translates to the retail side, which I believe it will, something will wake up the public, that's when we'll see real fireworks. And, of course, we're not there yet, but that's a benefit to all of you who are trying to add to your portfolio before the prices get out of hand, is one that continues to move up gradually, kind of like what we're seeing here. I would argue the difference right now between this market and ones in past is the corrections. The corrections are nowhere near what they were before, where you would see a correction and the price would get stepped on and go lower and lower and lower, wouldn't come back, like in 2011. The corrections that we are seeing now are very shallow. While they can be steep, they don't last very long, and the price comes right back. That is an underlying reality of physical demand at the highest levels. What's unusual about this one is the price. If you would have told me gold would be at $3,500, and most people wouldn't know a gold eagle if it fell on their foot, is shocking to me, which tells me we're very early yet in this bull market. But a price that continues to move higher without gaining any attention, to me, is very bullish, because it's the biggest money in the world that is pushing it higher, as the public is moving it completely and totally lockstep in the other direction. It's, to me, very, very bullish and a contrarian indicator that this is indeed happening. And before it happens, we continue to see things moving in the direction that we've talked about, maybe just not at the speed or in the manner that we thought. But here we are, looking at $3,500 an ounce gold. Let me just look real quick here, and then I'll let you go. We got gold right now at $35.39. I mean, come on. And we have up $85. And we have silver at $41 right now, up $1.15. So, really? Are we not moving in the direction that we think? I hope people understand this is a train that's just getting going, because the public, any of you who own gold and silver, try talking to one of your friends for more than 5 minutes about any of this stuff and watch what happens. And yet, here we are, silver at $41 an ounce, and you won't see a word about it on the evening news tonight. Or gold at $3,539. Don't tell. You won't see it on the evening news. But it's outperforming everything. It's the tortoise. It's not the exciting hare. It's the tortoise, and it will continue to do this. So this is just the beginning. If I were going to make a guess, I wouldn't be surprised to see $4,000 gold by the end of the year. I wouldn't be surprised to see silver knocking on 50's door or more by the end of the year. Now, I normally don't say that, and I don't like saying those things, but if I were going to take a guess, those numbers are wickedly in play. Very much so. I think maybe those are even undershooting where the potential could be, but that's not why we own it.
In today's news recap, Morgan Stanley raised its gold price forecast for the fourth quarter to $3,800, favoring gold, silver, and copper futures. Morgan Stanley published a report on the metal industry stating that a further weakening of the U.S. dollar should provide a tailwind for commodities. An increase in U.S. inflation could also attract inflows, and any stimulus policies from China would be an unexpected bullish factor for the industry. However, U.S. tariffs pose growth risks as the effect of stockpiling gradually fades. The bank prefers gold, silver, and COMEX copper futures. The bank expects tariffs on certain countries to be raised again starting August 1st, and tariffs on industries such as steel, aluminum, and copper may also affect and push up cost inflation in the industrial sector. Exports continue to support Chinese metal demand, but this support may weaken as tariff suspensions end. Morgan Stanley believes that the trends in the metal market this year will continue, with upside potential for COMEX copper, gold, and silver, but platinum is expected to stabilize after a roughly 50% rise. The bank has raised its fourth quarter target price for gold to $3,800 per ounce, supported by central bank and investment demand driven by a weaker dollar ETF bid and ongoing uncertainty, while jewelry demand may recover as consumers adapt to higher prices. The bank forecasts gold prices $3,800 per ounce in quarter 4 2025, marking a multi-year top as the bank expects $3,500 per ounce in quarter 1 2025, 2026, and $2,500 per ounce for the full years of 2026, 2027, and 2028, respectively. However, Morgan Stanley also points out that there are many uncertainties in the industry. Key issues include the path of U.S. tariffs on specific countries and metals, the outcome of the U.S. Section 232 investigation into critical minerals, and whether China will introduce more stimulus measures. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
Uninformed and hypocritical, because these are the same people that are all in equities at all-time highs, at the highest valuation since the 1929 crash. held up by 7 stocks, where the rest of the stocks in total are barely up at all on the Russell 2000. It's just naive as far as I'm concerned. And it's the fact that people don't understand that, yes, gold is at all-time highs or damn well near it, but because of overt suppression to make the dollar and the bond market look better than it is, or they are, no one knows how high gold and silver should be. But this is exactly the sentiment you would want if you're already positioned, because this is why so few investors ever make money. They miss the important part of the equation. The fundamentals, they don't understand, and they just look at price, which is the ultimate tool of misdirection. That's why they do it. The big money knows that they can mess with the price and everyone else just keeps on walking. The people who understand value, understand math, understand logic, they take their time to apply it to this thesis, to this idea, would walk away saying, yeah, that's exactly why the big money is accumulating it quietly. This is the don't do as I say, do as I do. I would say that those people who are making that assessment are making a very foolish and ill-informed, hasty appraisal of the situation. Have any idea either. I mean, the market continues to move higher, and it's without any regard for risk, or risk of prevention or aversion. So I think that the pensions are in very big trouble. I mean, where do they get their yield? They're forced into the equity market because they're not getting it in the bond market. They're forced into the equity markets at all-time highs, at all-time valuations. And I think this in and of itself is scary, because I believe that especially if we see a decrease in yield or rates, you got valuations at literally 1929 style extremes. You got all of the insiders, the veterans, Gartham and Buffett and Dalio. They're all talking of highlighting systemic risk. You have insiders selling, as we've talked about, the industrials, or the institutionals rather, Bezos and Zuckerberg unloading billions in stock. And I just think that this is a very, very dangerous time, where the insiders are moving out, but the hedge fund or the pension funds don't have much choice but to speculate. They're not getting the return that they had thought they would with treasuries, or had hoped for, so they have to, at that point, speculate into the equity markets, as some of the most informed money in the world is moving in the other direction. And buying gold, which doesn't pay a coupon, even though it's outperformed everything, they won't even look at it. They won't even think about it. So it's putting a lot of people and their future in trouble, in jeopardy. I look for the pensions and to have before it's all said and done, the pensions will be something that you hear a lot more about, just simply because they are forced to take chances in order